Hello, in this webinar we're going to look at how to create a new client plan from scratch, entering the assets and income and expenses into the plan to build up the cash flow chart. Once you've logged in to AdviserGo via australia.planwithvoyant.com or started the free trial, you'll then be directed into Plan, where you can go to AdviserGo. From here you land in your home page, and this will be where your list of clients are on the screen. And you go to create a new client plan to this plus button bottom right. Here I'm going to create a new plan for Jane Webb. She was born on the 1st of January 1981 and she's not already retired. Click done, and this will create the beginning of the plan for Jane Webb. And now we can add in her husband John. So plus button bottom right again. People, it's a spouse, and it's John Webb. He was born on the 6th of January 1978. I'm going to go to the right hand side of the done icon here because I'd like to add in their child. So save and add another, and it's going to be Felicity Webb, born 10th of January 2015. And done. That's everybody entered into the plan. You can see them in the people section here, and they each have a colour. The dashboard section is where you land on when you first log in, and this is where you enter everything into the plan. So it's in here in dashboard that we're going to be doing all of the work in terms of entering the expenses and the income and so on, and we'll see it all listed in here if we want to edit it later. We'll also watch the cash flow chart change as we bring things into the plan. Note, if you're presenting in the system to a client, you can hide the dashboard chart from in the dashboard view so that you can use the timeline and dashboard to show them what's in the plan and then save the chart for the Let's See screen. You would do this up here in the silhouette and go to Preferences to show dashboard chart. The other thing to do when you're in Preferences in the silhouette is turn inline help on to yes. We'll show you inline help as we go. The first thing I'm going to do before I enter anything into the plan is check my plan settings. The settings that Voyant provides are simply placeholders for you to get started, and for each plan have a look at these plan settings and check that they're suitable for this client and your firm. In here it gives you the defaults for what these things are going to be, but for many of these things, as you add the individual item, you can change it for that item. So I'll show you that as well. With inline help on, you can click on anything with a dotted green underline underneath it, and it pops up a help window, which means that you can learn, okay, where is this setting used in the system? Inflation rate, for example, is the default inflation rate on any expenses and goals entered, and savings and investment growth rates are the default growth rates for any cash savings accounts or investment and pensions accounts. As I say, you can change these on an individual item level. So at the moment, my default rate is that my investments grow at 6% and my cash savings accounts grow at 1.5. If I go into fees, you can see that all of these accounts have a 0.5% fee on them. So the net growth will in fact be 5.5 for investments and 1% for savings. I'll show you how to check that as we go. There are other sections here in your plan settings to have a look at, and we cover these in a separate video, but it is worth exploring these in more detail. First thing I'm going to add is their expenses, so plus button bottom right and expenses. I'm going to choose multi-year expense because this expense is for more than 1 year of the plan, and it's a jointly owned expense because it's their basic expenses. Now their basic expenses are $22,000 every year, And in terms of priority, it is a basic expense. So it's the highest priority level in Voyant, and it'll show up in the light blue line on the chart. If I go into timing, the expense starts now at the beginning of the plan and ends at the end of the plan, which is what I want. So I'm going to click this downward arrow here and save and add another, because now we have their discretionary expenses. This is $20,000 a year, and jointly owned again. You can select in this drop down who owns this expense, but this time they're going to be a leisure expense. Again, it's for the whole of the plan, and we'll click done. What we have now is the expenses for the chart. You can see that they're increasing each year by the inflation value. So if I go back to the expenses entry and click on basics, this inflation rate, the 2.5%, that default rate's taken from my plan settings. I can edit it in here if I'd like. That is the rate that these expenses are increasing by each year. You can see a light blue line and a black line, because the light blue line is basic expenses and the black line is leisure and luxury expenses. Note as well that the light blue line will also include things like taxes on salary, mortgage payments and insurance payments, and the black line also includes contributions into savings and investments. Okay, the other expense items I'd like to add in are going to be classed as goals. So goals are trackable expenses in Voyant. They really are pulled out in the reports and in the timeline screen, and you can see the progress towards those goals. So have a think for each client individually what it would be classed as a goal rather than an expense. And it could be anything from regular expenditure to I'd really like to buy a boat. In this case, I'm going to go to plus button and goals, and I'm going to do a pre-retirement goal, $40,000 every year, which I'm going to call pre-retirement holidays and trips. This isn't a basic expense, this is a luxury. And I go to timing. I entered it as a pre-retirement goal, so it's defaulted to the pre-retirement timing. I'm actually going to move this so it ends on Jane's retirement. Click on the event on the timeline to change the timing, set as end event. Now I'm going to click done. And now you see in their pre-retirement years, because it was a luxury expense, this black line has now moved up and then drops back down at retirement when that expense stops. Let's enter some post-retirement holidays and travel. So it's a retirement goal, retirement holidays and travel. 30,000, it's luxury. Let's check the timing. It starts at John's retirement event. We're going to change that so it starts at Jane's retirement event. Set a start event, and it ends at mortality. To the end of the plan. Click done, and we'll see the black line, because it's a luxury goal, move up in the chart in the retirement years, as we do. Let's now enter their income. So back to the plus button, bottom right, go to income, it's employment, and let's enter Jane's. So it's Jane's earnings. Salary right now is 70,000. And this is the growth rate the salary will grow at each year. So let's edit that to 2%. The default value is taken from your plan settings. I'm going to change it in this particular income to 2. Now let's check the timing. It's defaulted to Jane's end at Jane's retirement event, which is fine. So it starts now and ends at retirement. Note that you can step change the income within this window if you want by adding a step. For example, if there was phased retirement or a period of working part-time and so on, you can put that in as steps. Okay, I'm going to click done so we can see the impact on the cash flow chart as we've saved it. We now have these bars of blue coming in the pre-retirement years, and the light blue line has moved up because the light blue line includes taxes. If you want to see the detail, you go to year view, top right of the chart, and in cash flow you can see Jane's earnings starting at 70,000 and increasing each year by that growth rate that we put in when we entered it. Also in year view you can see the expenses. So here's the income tax, basic and discretionary expenses, as well as those pre-retirement holidays and trips that we entered as a goal, which is essentially an expense for that year in the plan. At the moment, this is the lowest priority goal, the luxury holidays and trips, and you can see this one is unfulfilled because there isn't sufficient income and assets in the plan yet to meet the total need, though they are meeting their basic needs with this income, which is the light blue line. Right, back to the dashboard, let's add the income in for the spouse. So employment, I'm going to change this to John. So John's earnings, these start at $80,000, but the growth rate on them is actually 1%. Let's check the timing. So they begin now and end at John's retirement, and that's fine. So now there's the opposite happening in terms of there is surplus income in the plan, whereas before there was a shortfall to meet the total needs. Now that we've added John's income in, there's actually income coming in to the plan that's above the black line. In other words, there's surplus. By default, Voyant assumes that surplus is spent, and in other words, they lived their income. But you can change this by saving into investment or pension savings, or by changing your calculation settings. If you go to income and any of these inline help topics, the savings surplus video will walk you through how to do that. To check whether it's been saved or not, we go to year view, we check in investments, and there's nothing here, so there's nothing being saved into any of the accounts because you'd see it in this section here. If we now look in the investments section in dashboard, you'll see that Voyant has created these cash sweep accounts automatically. So every time you enter someone into the plan, they're each given a cash sweep account. This is so Voyant knows where to put surplus money if you did say it was saved, or for example if you're downsizing a property, that sort of surplus is automatically saved and this is where it goes to. So watch out for money going into Jane's cash, John's cash and so on in the year view. Let's now add their emergency fund. Plus button, this time we go to savings and investments. Okay, I click on savings, it's a jointly owned account, it's a savings account and I'm going to call it emergency fund. In here they have 33,000 and it's growing at 0.5%, 1% gross minus 0.5% fees. Now, the key thing about this emergency account is that it is not used in the plan. It needs to be ring fenced. In order to do that, go to withdrawal limit and in type set as do not allow. This ring fences the entire account and the growth in it. If you'd like to ring fence just a balance of it, for example $10,000, you can go to minimum balance and ring fence a particular amount. But in this case, we're going to say do not allow, and that will mean that Voyant's not allowed to use this account to meet their expenses in the plan at any point, even if there's shortfall. When you look at timings section for savings, investments and pensions, this is all about the contributions into these accounts. So in basics, if there is a contribution coming from their surplus salary, you need to put in a contribution amount into this box here down the bottom and then say in the timing screen when this contribution starts and stops. So if I save this, it's not actually going to make any difference to the cash flow chart because Voyant's not allowed to use this account in the plan. So as you see, nothing has changed. There's still the same red starting at the retirement events and going throughout the whole of the retirement phase. Now if I add a general investment account, again you can put in a contribution, check the growth. You can change these fields here if there's dividends and interest and whether reinvested, whether any of these gains are realised annually. And then we're going to click done, and this will change the chart because this account is available for use. And you can see here that it's using it until it runs out in these initial retirement years. Again, go to year view by double clicking on the bar or year view top right, and we can see the investment account withdrawal over here until the balance is 0. Clicking on the names of things in the year view will expand more information about them. Okay, back to dashboard. Now let's add in their other savings account before we add in their supers. So I'm going to the plus button, bottom right again, selecting savings and investments, and this is their savings. In this account they have $76,000 and it's growing with 0 fees but with 0.5%. There's no withdrawal limits on this account, so I'll click done. You see now the blue extends a little bit further because we now have both the investment and the savings accounts to use. So now let's start adding in their supers. To add a superannuation scheme, go to that plus button bottom right and click on pensions. From here you select the top, superannuation, and make sure you've got the right owner. They both have an accumulation phase super, so I'm going to call this Jane's Accumulation Super, and it's got a current balance of $80,000. Enter in the cost basis for these balances, the fee rate taken off of the gross growth rate, and whether it's an employer linked plan. Now if I select yes here and link it to an employment, this will automatically start the guaranteed employer contributions in Voyant. What it also reveals is this salary sacrifice contribution field where you can then say how much they're contributing to this account from their salary. It will then ask you to update timing, which is by clicking here or by going to the timings tab up the top left, and this is to say when the contributions into the super will start and stop. So either click and drag the event or click on it and set as end event. In this case this is Jane's super, so it'll be Jane's retirement that the contributions will stop at. I'm now going to save and add another. This is now going to be for John. John's Accumulation Super. The starting balance for John is 100,000 in the concessional balance. Let's put in the other details. It has the employer contributions, which will be a percentage based on John's earnings in the plan, and he also has some salary sacrifice. Now let's click on timing and see the contributions start now and stop when John retires. And what you can do with all the supers that you enter is go to the growth screen and check that this is set up how you'd like. Click on the growth rate, it gives you a bit more information. And if you go to the basics tab here, anything with the dotted green underline, it pops up the help window. There's a watch tab and you can watch a video on entering a super here, or emails for help via this email address. Okay, let's now go to save and add another. So for each person we're going to have an accumulation and a retirement phase. So Jane's retirement super, check the growth. I'm actually going to put the growth down in this one, and there's no gains realised annually. Then save and add another. Add John's retirement super. Nothing in it yet, but it will hold money in the future. Back to growth. Again, I'm going to put this down to 5. So the net will be 4.5 after fees, and there's no gains realised annually. Okay, I'm done. I've now added in 4 different supers, so 1 each accumulation and 1 each retirement. What I need to do now is tell Voyant to move money from the accumulation pension to the retirement pension at retirement, because this pension here is actually just still in the accumulation phase. If I click on the bar and I go to pensions tab, you can see it's the accumulation pensions in here. So what I need to do next is go to dashboard, go to the plus button, and this time go to transfers to say, okay, move money from Jane's accumulation super into her retirement super, all available. If the amount was greater than the transfer cap, it would limit the transfer into the retirement super to the transfer cap. Let's go to timing. This is for Jane, so this transfer is going to be at Jane's retirement event, but you could create a new event on the timeline by double clicking and transfer at this new event instead of at this retirement event. In this case, I'm going to use Jane's retirement event. Then I'm going to save and add another and do the same for John. So now it's going to be from John's accumulation super to John's retirement super. It's helpful choosing good names for those super accounts so you know which to choose in the transfer window. All available, and this time it's at John's retirement. So now we show the required withdrawals from the super in retirement, and if we go to year view, we can see in this year the income is made up of John's retirement super, Jane's earnings, and a little bit of the savings. This brings us on to in what order Voyant uses the assets and income in the plan to meet the expenses. Voyant will always go to income first to meet needs. So if there's income in the plan, such as employment, it will use that first. After income, it will then go to cash, so their savings, and then after savings, it will follow the liquidation order. The liquidation order is found in dashboard in your plan settings, liquidation order, and in here you can see which order you'd like to use the different accounts in. So in this one, we're using the investment account first. So when there's more income needed than just what's coming out of the required withdrawals from the super, it's taking it from the investments as opposed to from the super. Note when you're in the dashboard screen, if you go to the 3 buttons top right, you can turn on the legend to see what each of the colours represent. Okay, we're not quite done. The last things to add is there are 2 properties that they have in the plan. So if I go to the plus button bottom right, go to property, there's 2 properties to enter in here. There's the family home, worth 450,000, and there's a rental property that they own as well at the moment. Check the growth rate on your property entries. This is the value the property will grow at every year in the plan. If I click edit here, I'm actually going to change this to 1% for this property, and also have a look at timing. This property is assumed to already be owned. In basics, it says, is this a future purchase? No. And it's owned from now until the end of the plan. There is a linked debt on their family home. Create and link a new debt. I'm going to create mortgage on family home. The balance, current balance of the mortgage is $200,000, interest rate of 1.5%, and they're paying off $1,000 a month. You don't need to enter the payment duration. Voyant will calculate that for you automatically. So now I click done, and this has linked this debt to this property. That means that if I model selling the property in the plan, this debt will be paid off at that time, and therefore the regular payments on the debt will stop. Now I'm going to save and add another. I'd like to add in their rental property. Again, it's jointly owned. This time it's a rental property that they own. I'm going to select rental, and it has a market value, current market value of 300,000. They purchased it for 280,000, and the growth rate on this is 1.5%. We'll see. Now, again, they already own this rental property at the moment, and it's generating some income for them, but they also have a mortgage on it. So let's start in linked debts. Let's link to a new debt. If I'd already created a debts using the debts section, I could link to it here, but in this case I've not, so I'm going to put it in this section. This is the mortgage on their rental property. The balance is $123,000 and the interest rate's 2%. The payment of this is interest only, and it will automatically calculate the interest only payment amount for you. Okay, so I click done, and now I'm going to add a linked income. So this is the income that the rental property is generating. So I'm going to call it rental property income. Again, if I sell the rental property in the plan, this rental property income will stop. This is going to be $12,000 a year, and it's taxable. It will grow, but not by 3%, it'll grow by about 1%. Finally, if there's any linked expenses, such as managing the property, repairs, etc., you can do exactly the same thing for an expense. Put in the expense amount and whether it's a basic, leisure, luxury, priority. Okay, I'm going to save that property entry. I've created the property details in here. I've linked a debt, I've linked expenses, and I've linked an income. And now I'm going to click done. That's us now created a plan in Voyant AdviserGo. You can now do a check against your fact find to check that everything's entered as you'd like. There's a couple of places to do that. So in dashboard, click on the downward arrow here. Check the amounts in this column here, annual amounts in terms of the account balances, super balances, value of properties and expenses. Also, you can check the owners on the left. So if you hovered over, you can see they're joint. Some of them are jointly owned. Blue is representing John and green for Jane. The other place to check that it's set up how you'd expect is by going to Year View and checking through the cash flow and expenses that everything's entered as you'd like. What this is showing is that they have enough to meet their needs in the initial years of the plan, but then the rate of inflation on their expenses, which is the black line, increases more than the increase on their income. So eventually they're needing some other savings to meet their needs as well as their income. When it gets to retirement, they are using their super and their taxable savings, as well as their other income from the rental property, and later on their age pension. If I click off details, it shows you more obviously that that's 86 in the plan. There's a shortfall. In other words, there is insufficient assets and income in the plan in order to meet their needs. If I go to Let's See, dual chart, be able to look at the chart with the assets chart and You can see even when there's red in the plan, there's still that taxable account, which will be their emergency fund that we set up, and the non-liquid, which is their 2 properties. Thanks for listening to this video on how to build a plan. We'll cover other areas of the system such as insights and how to do what ifs and reports in other videos.